This is a bull call spread, and what a bull call spread is buying one call and selling another call. So a lot of times, in this kind of environment, I think it's okay to be doing spreads instead of outright options. So we see here, this is a spread. So in a bull call spread, you buy a lower strike call to sell a higher strike call. So you're going to sell a lower strike call to buy a higher strike call. So your risk on what you pay for the trade is going to be the amount you pay for spread. So if you buy a dollar call spread for 20 cents, most you can ever lose is $20 per one lot. Ooh, we just see some, what did we just see hit? American calls being bought. IVZ calls being bought. Okay, so the most you can ever lose when you buy a bull call spread, so your risk is limited to what you pay for the call spread. So you buy a $1 call spread for 20 cents, you can lose $20 per one lot. Minus commissions, obviously. Your reward, okay? You give up some of that reward when you buy spreads. The most ever you can ever make is the price of the spread minus what you pay. I repeat that. The most you can ever make is the price of the spread minus the price that you pay. Break even. To figure out your break even of a call spread is the lower strike plus the amount paid. If you buy the 25-26 bull call spread for $1, your risk is $1. It can turn into $5 minus the $1 you paid. So you can make $4. Lower strike plus your price you paid is your break even. So anytime you guys do a spread, if you hold it till expiration, and this is always if you hold it till expiration. If you don't hold it till expiration, then things can change. But if you hold it to expiration, the most you can ever lose is what you pay for the spread. Most you can make is what the spread's worth minus. And then your break even is the lower strike plus the amount you pay for the spread. Time decay. Time decay hurts the spread when it's out of the money. The last couple of days I've been buying some spreads. I've been buying some TSM call spreads. And time decay is going to be against you if the spread is out of the money. Delta. Anytime you're long a bull call spread. Okay, anytime you're long a bull call spread, you are long delta. Anytime you're long a bull call spread, you're long delta. Gamma, it depends where the stock is trading at the time. So delta can be variable. That depends where the stock is trading at the time. Gamma, same thing. Vega. Once again, guys, these are all variable. And this is like one of the questions I always said. People always say they're really good at trading derivatives. I'm like, if you're long a bull call spread, are you long a short gamma? And the answer is, it depends where the stock is trading at the time. Sometimes you can be long, sometimes you can be short. Row. Okay. I mean, most of the stuff you really don't have to worry about that much. If you look at the slide here, the thing I would really focus on here is if you're long a bull call spread, you're long delta. Okay, so you're always long delta. And then what you can lose is what you pay for it. The most you can make is what it's worth, the difference between the strikes minus what you pay. It's kind of like it. Bear put spread. Most you can ever lose when you buy a put spread is the amount you pay for the put spread. Just like a call spread, but to the downside. Maximum reward is the difference in strikes minus what you pay. Break even. So this is just complete opposite of the break even. This is going to be the higher strike minus what you pay. So higher strike minus what you pay. Theta is variable. Your delta is always short. When you're short a put spread, you're always short. So once again, what's important on this slide? Okay, I want you guys to understand everything, obviously, but what's important is what you risk when you buy a put spread, what you pay for it. Most you can make is the difference in strikes minus what you pay. And your delta is always going to be short on a put spread. If you're long a put spread, you're always short. If you're short a put spread, you're always long. Here is a bull put spread. And a bull put spread means you're selling a put spread. Okay? Maximum risk. Higher strike minus the lower strike. Maximum reward is the credit you receive. Okay? So it's just a complete opposite here, guys. So it's just a complete opposite of buying it is selling it. Okay? So the most you can make is what you sell it for. This is why I don't like to sell a lot of out-of-the-money put spreads, especially for some cheap dollar amount. I just don't think they're like good reward or risk setups. Like selling a $2 put spread for like 20 cents, I just don't think it's okay. Time decay is always variable. Delta, if you sell a put spread, you're always long, guys. Okay? So things that are important. If you sell a put spread, most you can make is what you sell it for. Most you can lose is the difference in strikes plus the price you sold it for. Delta is always going to be positive. A lot of these other ones, just don't worry about so much, guys. That's like next level. Okay? You want to know your break-even's fine, though. Bear call spread. So in this one, you're selling out of the money call spread. What you can do is you sell the lower strike and you buy the higher strike. So if you sell a call spread, most you can ever make is what you sell it for. Sell a call spread, most you can ever make is what you sell it for. Most you can make is the difference in strikes. Sorry, the most you can make is what you sell it for. Most you can lose is the difference in strikes minus what you sold it for. Maximum reward, credit received. Time decay, depends. Delta is always going to be negative. You're short a call spread, you're always negative delta. Okay, so once again, just get that maximum risk, the maximum reward, maybe the break even, and you're good. You don't have to worry about the gamma, the vega, theta, or any of that stuff, really. Your delta is always going to be short. So the first couple lessons, we taught you calls, we taught you puts. Now we're teaching you spreads. What is a spread? How to put it on? Ratio spreads. Not a big fan of a lot of these spreads, guys. So the first one's called a 1x2 put call spread. A lot of people say you can do 1x2 call spreads against your long stock position. If you want to do that, that's fine. It's just not like my cup of tea. So in a ratio call spread, you buy one call to sell two calls. So you buy one call to sell two call spreads, okay? Maximum profit is it expires on your short strike. A lot of you guys in here should never ever be doing 1x2 call spreads. If you're doing a 1x2 call spread against a long stock position, that's fine. But I don't suggest doing 1x2s at all. Break even, strike minus what maximum position of the put. Here's an example. That's a bad example. We'll put it in a different example. Let's say Apple is trading 163. Let's say you do the May 145, 125, 1x2. Okay. So you buy the 145, you sell two of the 125s. Okay. You do a 1x2 spread. So 1x2. Ooh, selling in penny spike. Might I get after this? Neo 21 and a half. I'm gonna buy some of these. Neo 21 and a half. So I'm gonna buy some of these. Ooh, there's 1,000 of them offered. That was fun. Okay, so let's say Neo. Let's say we do a spread here. Let's say we do the weekly 20-22 call spread. So you buy the 20s, you sell two of the 22s, and you're gonna do that for 21. You're gonna pay $21 per one lot. So you buy 120, you sell two of the 22s. So it costs you 21 cents. I don't even want this trade anymore. So it's a 1x2 call spread. You buy one to sell two. Okay. You buy one to sell two. You do that for $22. You always want it to end on your short strike. You always want it to end on your short strike. That's the goal when you do a 1x2. So you want it to end on your short strike, guys. You want to end up on your short strike. Okay? And we're doing 1x2 spreads. Butterflies, yeah, butterflies make more sense than a 1x2. I totally agree with that. Ratio verticals. You know, I always do like, I would like cover the other side of it. So I don't really like, let me see how high Neo can get today. They just bought some Neo calls. It gives him the whole week. I might hold these. I don't know. Sell 1. To buy 2. So I don't really like this. I don't really like ratio spreads. If you do butterflies, it's completely cool. So if you do butterflies, I think that's cool. But I really just don't like 1x2s at all to the long side or to the short side. I really just don't like 1x2s at all to the long side or the 2 side. So I wanted to kind of teach you those, but I don't really like them. Don't really like them here. Don't trade 1x2s is basically the synopsis here. Always have a protection on it. This is a butterfly, guys. I do butterflies here on measured move targets. So I don't hate butterflies. So a lot of times I'll do butterflies. And what I'll do is butterflies on the measured move target. So the middle strike is always where you want to go. So on a butterfly, it's actually like one of my favorite strategies. You buy 1, okay? You buy 1. You sell 2 in the middle, and then you buy 1 more. So it's a 1x2x1, okay? So you buy 1 to sell 2 to buy 1. Most you can ever lose on a butterfly is what you pay for the butterfly. So if you do a $1 butterfly for 20 cents, the most you can ever lose is what you pay for it, okay? So this is gonna have 2 break evens. You know, one of the bad things about a butterfly is if you get it too far, let's say I'm bullish and I want to put on a butterfly, if it goes up too much, you start losing again. So it really kind of needs to stay in a range. It is one of my favorite strategies, to be completely honest, guys. But you can lose money here on a butterfly if it goes up too much. So if you're, oh, the stock's gonna go up, it goes up too much, you still lose, right? But butterflies have good reward to risk setups, in my opinion. So the most you can ever lose on a butterfly is what you pay for it. The most you can ever make is the difference between the highest one minus the amount paid. So you put on a $5 butterfly for $1, you can lose $1. It can go to 5, so you can make 4. Delta, gamma, don't worry about so much. Just know, like, I like trading butterflies on measured move targets. So I do like trading butterflies here on measured move targets. So I do like to trade butterflies here on measured move targets. Okay? Especially for earnings. Takes away a lot of the volatility too. Christmas tree. You can tell these slides are kind of old. I can't tell you the last time I put a Christmas tree on. It's probably been forever. I would never do a Christmas tree right now. But if you want to know what a Christmas tree is. So what a Christmas tree is, it's buying strike A, skipping B, selling 3 of C to buy 2 of D. Okay? So once again, guys, this isn't something I would do. I mean, if you want to do this, you're on your own. This is a technical, there's like 27 different kinds of trading strategies. This is technically one of the trading strategies, but like I said, I wouldn't do this here on this trade. So you buy strike A, you skip B, you sell 3 of C's, and then you buy 2 of D's. It's like a kind of like a weird, it's kind of like a butterfly. It's kind of like a butterfly here. Cool. Christmas tree butterflies can also be done with puts. Once again, I wouldn't do the strategy. You'd buy strike D, skip C, buy 2 of, sell 3 of B to buy A. You know what I say to this spread? No, thank you. I'll just pass on this spread. I don't need to do it. Long straddle, okay? If someone said to me, AK, what's your least favorite strategy? It might be a long straddle. It is so hard to make money on straddles, guys. You have to like time it like perfectly. So straddles, I don't like to buy straddles. Of course, I don't sell straddles either. Never going to sell a straddle naked. You can blow out your whole trading account. So if you buy a straddle, most you can ever lose is what you pay for the straddle. You have to time it perfectly, guys. It's really, really hard. Maximum risk is the premium paid. Maximum reward is unlimited. Anytime you buy calls, you have unlimited reward. Simple and easy. Break even, it's the strike plus the price paid. Strike minus the price paid. Simple, easy on that straddle. Short straddle. Never, ever, ever sell a straddle naked. I will repeat that again if you'd like to hear it again. Never, ever, ever sell a straddle naked. The reason you want to sell straddle naked is blowout risk. Anytime you sell calls, you can blow out your whole trading account. We don't want to blow out our trading account. We want to put on reward to risk basis, reward to risk trades. So I would never, ever do this. But if you did do it, you should know the most you can lose is what? Infinity. Most you can make when you sell a straddle is what you sell the straddle for. So the most you can ever make is what you sell the straddle for. Break evens, once again, you're going to have 2 break evens. Your break even is going to be your upper strike, the upper plus what the credit you received, lower minus the credit you received. Okay? Simple and easy. Actually, this should not, it shouldn't have upper and lower. That would be a strangle. So it's time decay is always good when you sell straddles naked. Delta all depends where the stock is trading at the time. Gamma, you're going to be short gamma, which means you don't want movement. If you're short gamma, you're long theta. Vice versa. There's been situations you can be long gamma and long theta. It's very rare though. Volatility will hurt this position. There's been days like where the straddle can just go up in value and I lose money. Long strangle. Actually, I would say long strangle is a worse strategy than a long straddle. So long strangle, you buying out of the money call, you buying out of the money put, you're expecting a big movement. The most you can ever lose is when you buy a strangle is what you pay for the strangle. Most you can ever make, we just talked about it, anytime you buy a call, you can make an infinite amount. Break even. Then we have time decay. Okay, time decay when you long a straddle is negative. Time decay is negative here, guys. Neo, you suck. Delta, it depends. You get long as the stock goes up, you get short as it goes down. So you get long as it goes up, you get short as it goes down. Gamma is always positive. When you're long options, you're always going to positive gamma. When you're short options, you're short gamma. Simple, guys. Vega, you're long volatility. So if volatility goes up, you can make money. If volatility goes down, you lose money. Simple and easy. Okay? Simple. Short strangle. Hate short strangle, guys. So we're combining all these different option elements. You know, we were talking about not throwing one trade today. I think the Neo trade's good. I bought 200 Neo calls, guys. So if you want to take something, you can take Neo calls right now. I bought them at 16. They're down to 15. Maximum risk when you're short a strangle is always unlimited, guys. The stock can go to infinity. Maximum reward is the price you sell the strangle for. Simple. Okay? Break even, upper strike, minus your credit received. To the downside, lower strike, minus your credit received. Theta is going to help you. If you're short strangles, time is on your side, as we say. Delta, you'll get short as the stock goes up. You'll get long as the stock goes down. Gamma, we're going to be short. Volatility will hurt this position. These are short options. Anytime you're short gamma, you're short Vega. Anytime you're long gamma, you're long Vega. Rho, don't have to worry about. And that's it for today's lesson, guys.